On today's broadcast, education planning, the importance of saving for college, college savings vehicles, and the financial aid process. So get ready. Focus Planning Group's education series begins now. Today we will be discussing education planning, specifically saving for college. You each have a workbook in front of you. I encourage you to utilize this throughout the presentation. During this presentation, we will discuss the importance of saving for college, methods of saving for college, and the financial aid process. Saving for a child's higher education cost is a large investment, and it is only going to get larger. The cost of higher education is projected to increase at a rate of 6% annually. This means that a child born today can expect the cost of college to be 3 to 4 times that of current college prices. The chart on this slide shows projected annual cost of college for public and private institutions through 2026. You may be thinking, yeah, college is expensive, but there is always financial aid. The fact is that financial aid doesn't cover everything, and some forms of financial aid are loans, which must be paid back with interest. Even with financial aid, there may still be a large out-of-pocket cost for attending college. By saving now, you can help lessen the financial burden on your family when the time actually comes for your children to attend college. The graph on this slide shows the components of total sticker price for college. As you can see, an average of over 30% of the sticker price of college is an out-of-pocket expense for the family. At such a high cost, parents may wonder what the benefit of a college education is for their child. Studies have shown that a college graduate will earn anywhere from $500,000 to $1 million more in a lifetime than non-college graduates. The graphic on this slide shows one such study. The figure accounts for the cost of college and the earnings that a child could have earned had they not attended college. This slide only shows the tuition cost when calculating the net payoff, as an individual would incur living costs whether or not they attend college. So now that we know families should save and why they should save, one might want to know how much a family should save. As a rule of thumb, a family should aim to save 50% of the projected cost of a child's college education. For example, say you have a child that plans to attend a public university for 4 years. Based on the information provided, this family can project the total sticker price for their child's college education to be $181,752. Ideally, the family should aim to save $90,876. I think we can agree that for most American families, this is a substantial amount of money. The mere thought of sending a child to college can be overwhelming. However, this should not lead to inaction on the family's part. Saving some is better than saving none, and starting early is essential, as you can see from our bottom statistic. When choosing a college savings vehicle, a family should consider the potential for growth, what type of investments can be held within a specific college savings vehicle, risk of loss, are the investments in the college savings vehicle subject to fluctuations, tax implications, how does the college savings vehicle impact taxes now and in the future upon withdrawal? Ownership and control. Who is in control of the funds placed in the vehicle? Who do the funds in the vehicle belong to? Ease of management. How are the funds managed? Fees and expenses. What are the costs of having a particular college savings vehicle? Now let's talk about which college savings vehicle is right for you and your family. There are several college savings vehicles to consider, including 529 plans, Coverdell education savings accounts, custodial accounts such as UGMA accounts, and savings bonds. 529 plans are a very popular way to save for a child's education. There are 2 types of 529 plans: college savings plans and prepaid tuition plans. College savings plans are the more popular of the 2 options. They are state-sponsored plans that allow an account holder to establish a college savings account for a beneficiary and use the money to pay for tuition, room and board, mandatory fees, and required books and computers. The money contributed to the account can be invested in stocks, bonds, mutual funds, or money market funds. The earnings are not subject to federal tax or state tax in most cases, as long as the money is used only for qualified college education expenses. Any adult can contribute to any 529 savings plan, regardless of their state of residence. However, there may be tax advantages to contributing to the plan that is offered by your state of residence. Contribution limits vary with these plans and are only limited by the minimum and maximum set by the plan. You are allowed to invest in various mutual funds, ETF portfolios, and age-based investment options. Rates are not guaranteed with a college savings plan. 529 prepaid tuition plans allow parents, grandparents, and others to prepay tuition at today's tuition rates at eligible public and private institutions. Essentially, the account holder is able to purchase tuition credits at their current price with the intent that the credits will be used at some time in the future when tuition costs will have most likely increased. It is important to note that these plans generally do not cover room and board expenses. Like the savings plans we just discussed, prepaid tuition plans are state-sponsored plans and only available in some states. But it is possible to participate in a prepaid tuition plan outside of the account holder's current state of residence. It's important to note that prepaid tuition plans are offered by state and private institutions. In addition, unlike college savings plans, prepaid tuition plans are generally limited to the plan that is offered by your state of residence or within your state of residence. Contribution limits vary by plan, and generally 1 to 5 years tuition can be prepaid. These plans do not have investment options. Instead, funds are pooled together and invested by the state or institution on behalf of the beneficiary. Typically, a certain rate of return is guaranteed. So which plan is right for you? I encourage you to keep in mind that the 529 college savings plans do have some advantages over the 529 prepaid plans. They grow tax deferred, and withdrawals are tax free if used for qualified education expenses. Contributions may be tax deductible depending on the state and plan, and the owner of a college savings plan maintains control over the account for the lifetime of the account. Coverdell Education Savings Accounts are another college savings vehicle option. Coverdell Education Savings Accounts allow eligible individuals to deposit up to $2,000 per year in an educational savings account for a child without being taxed on earnings from interest, dividends, appreciation, etc. There are income thresholds that an individual must be under in order to be considered eligible for a Coverdell account. These threshold limits are a modified adjusted gross income of $190,000 or less for a couple filing taxes jointly and $95,000 or less for an individual filing taxes as single. There is a phase-out contribution limit for a couple filing jointly with a modified adjusted gross income of between $190,000 to $220,000. The phase-out contribution limits for an individual filing as a single with modified adjusted gross income are between $95,000 and $110,000. Like 529 savings plans, earnings in a Coverdell account grow tax deferred, and withdrawals are tax-free if used for qualified education expenses. Education expenses from kindergarten to college are considered qualified. Coverdell accounts incur fees and charges, which can have a large impact because of the low contribution limits. Also noteworthy, a Coverdell account must be started and all contributions made before the child is 18. Next, we will discuss custodial accounts. A custodial account is used to hold and protect assets for a minor until they reach the age of majority in their state, commonly referred to as UGMA or UTMR accounts. UGMA is an abbreviation for Uniform Gifts to Minors Act, and UTMA stands for Uniform Transfers to Minors Act. Using custodial accounts as college savings vehicles has its advantages and disadvantages. Some advantages are there are no contribution or income limits. Withdrawals may be used for any purpose without penalty. Also, the investment options for custodial accounts are nearly limitless. Some disadvantages to using custodial accounts as a college savings vehicle are that when the child reaches the age of majority, the child takes control of the account. Another disadvantage is that the account counts as the child's assets for financial aid purposes, which may have an impact when determining financial aid. We have all heard of or experienced a grandparent purchasing a savings bond for the purpose of savings for a grandchild's education. A savings bond is a debt security that offers a fixed rate of interest over a fixed period of time. The interest paid on a savings bond is not adjusted for inflation, nor is there potential for growth, since the purchasers know exactly how much they will get in the future at the time of the purchase. The interest from these bonds is tax-free if used for qualified education expenses. However, the rules for savings bonds for education can be complicated. Therefore, savings bonds are not a popular or efficient way to save for college. This chart, which is also featured in your workbook, is great for comparing the different types of college savings vehicles. Now that we have discussed why saving for college is important and why to save for college, it is time for us to go over the financial aid process. Once a child is nearing the end of their high school career, it is time to start applying for financial aid. It is beneficial, however, for a family to know how financial aid is calculated before a child starts applying for aid. Generally, when a person is referring to financial aid, they are talking about a student's financial need. To determine a student's financial need, there are two methodologies which can be used separately or together, depending on the institution to which the student is applying. There is the federal methodology or the institutional methodology. When using the federal methodology, an individual fills out a FAFSA application. When using the institutional, an individual fills out a CSS profile and possibly the FAFSA as well, depending on the institution. Both the FAFSA and the CSS profile require a family to disclose information about their income, assets, and other non-financial information. Using this information enables us to determine the expected family contribution, EFC, the amount of the money the family can expect to contribute towards their child's education for the year in which the FAFSA or CSS profile was filed for a specific institution. The financial need of the student is then determined by subtracting the expected family contribution from the cost of attendance of a particular institution. Based upon a child's financial need, they may receive such aid as grants, loans, and scholarships. There are two forms of financial aid: need-based aid and merit-based aid. Need-based aid is determined by a student's financial need. It is specific to the individual student and the institution. Having a financial need makes a student eligible for need-based aid, such as grants, scholarships, work-study programs, and student loans. The other type of aid is merit-based. Rather than being based on a student's financial need, it is based on the student's academics, athletic ability, musical talents, or other merits. Merit-based aid reduces a student's financial need, which can in turn reduce their need-based aid eligibility. Merit-based aid can be in the form of grants, scholarships, and tuition discounts. Because saving for a child's college education is not the only thing a family is saving for, they may be faced with a dilemma of saving for a child's college education versus saving for retirement. Here are a few things to keep in mind if you feel the same way. There are no loans, grants, or work-study programs for retirement, so err on the side of saving for retirement. Paying for a child's education is not going to help the parents much if they have to move in with their child later because they have no retirement savings. If parents feel the need to dip into their retirement accounts to help pay for a child's education, it should be their last resort. The biggest takeaway from this is to start saving now, whether it be college or retirement. Here are some strategies to consider when saving for college. Start early, transition to a more conservative strategy as college nears, diversify investments, save regularly, save in the parent's name, not the child's name, save in tax advantage savings vehicles. Talk to your high school guidance counselor as college nears. They are valuable resources when discussing application requirements and local scholarships that your students may be eligible for. There are many online resources you can refer to for information about savings for college. As we bring this presentation to a close, there are a few main points that I feel worth repeating. The cost of college is rising at a rate of about 6% per year. This makes it more important than ever to save for a child's college education. 529 plans are the most popular way to save for college, specifically college savings plans versus prepaid tuition plans. When it comes time to apply for financial aid, there are two methodologies used to calculate financial need. The federal methodology using the FAFSA form and the institutional methodology using the CSS profile. Lastly, financial aid is comprised of need-based aid and merit-based aid. Thank you for taking the time and listening to our education series. I hope you found the information helpful. If you have not already downloaded your free workbook, please remember to click on the link below. If you have any questions, please see our contact information listed on this screen and on the bottom of the page. I love educating and teaching wealth management, so your questions are welcomed. You can always find us on the web at focusplanninggroup.net, and please remember to subscribe to our YouTube channel for more great educational videos, and follow us socially via Twitter, Facebook, Google+, and LinkedIn. You can find links to our social pages on the bottom of this page or on our website, focusplanninggroup.net. For Focus Planning Group's education series, this is Joe Carbone.